Hey everybody, what's going on? It is James here, and I wanted to sit down and shoot a video about options, and more specifically about selling options versus buying options. And I want to be very clear early on in this video that I would not consider myself an expert at options. It's something that I dabble with a little bit on the side, and I've been getting more and more interested in them as time goes along. So there's a reason that I'm interested in options so much, and it's because the standard advice when it comes to trading is you should always trade with at least 2-to-1 reward to risk, okay? And oftentimes you hear it called risk reward, but it really is reward to risk, 2 reward 1 risk. And that's pretty much like accepted or common knowledge. Always go for at least 2-to-1. And like if you go through like my course, I talk about it a lot in there, and it's fine. Only within the last year have I started to kind of update that and say, look, there's more than one way to attack this thing. And what you have to understand when it comes to markets is it's not really retail driving markets. We kind of fall victim to the mentality that, oh, it's panic and greed driving the market, and it is to a certain extent, but it's not retail traders, it's institutions, right? About 90% of all volume is institutional volume. So there's a very good chance that anytime you take a long, there's an institution also longing the same asset, and there's also an institution shorting the asset. Anytime you take a short, there's also institutions on both sides of that trade. And so you're always trading with and against institutions for the most part. Anytime you get an imbalance where there's not institutions on both sides, that's where you end up with gaps in the market, okay? So if you think about that, how is it that smart money is taking both sides of the trade? And there's a very simple answer to this, because some smart money is trading with a high reward to risk type of system where they are winning maybe 30 to 50% of their trades, but they're making a lot of money when they're right and losing a small amount of money when they're wrong. But there are other systems out there where they might be losing, for every dollar they win, they might lose $5 when they're wrong. So they're actually trading with like a 0.2-to-1 risk to reward, reward to risk ratio. So they're actually making about 1/5 as much when they're right as they're losing when they're wrong. And so then the question becomes, well, how does that work? How do they make money? And the answer is, think about insurance companies. Okay, think about any insurance company, whether it's home insurance, car insurance, life insurance, whatever. So if you take like a person who has life insurance, let's just say for easy math, they have $1 million worth of life insurance. All right, and let's say they pay $100 a month for that life insurance. Well, if they don't drop dead, which hopefully they don't anytime soon, right? That life insurance company is only making a little bit of money, $100 a month, right? Is what they're making off that premium. If that person was to unfortunately pass away, the life insurance company would pay out a huge amount of money, maybe $1 million in this case. They still make money because they know statistically that they're going to quote unquote win a lot more than they lose, right? So for every one person that passes away early on and ends up, collecting a big life insurance settlement, there are hundreds or thousands of other people who pay for decades and never collect, end up canceling the, for whatever reason. So for example, I've had life insurance for, going on 20 years, and it gets more and more expensive every year. So maybe I'll cancel someday and I'll never actually use the policy. So think about markets that way, okay? When you're selling options, you're essentially acting as an insurance company, and more specifically when you're selling puts, okay? So I wanted to kind of explain that first, because now what I'm about to show you is going to make more sense. So let's take a look at AMC, and I'm just using AMC as an example because it's kind of a meme stock and it's, a fun stock to talk about. AMC right now is around $20.39. It's been dropping for a few days now. Dropped roughly 41% since March 29th, so about a week, right? Pretty big drop in a week. So we may say, I don't think this is going to drop much further before getting some kind of bounce. We don't know how far it's going to drop. We don't know if it's going to go up right away, whatever. So we don't necessarily want to buy shares, because if it keeps going down, then it would stop us out and we would lose money. But what we can do, if we wanted to, and I'm not saying we should, I'm just using this as an example, I could go over here and I could sell puts. And when you sell a put, what you're doing is you are guaranteeing the buyer that you will buy 100 shares of that stock from them at the strike price. So this is the strike price. This happens to be Robinhood. Different platforms look different. Robinhood's probably got one of the easier interfaces when it comes to options. I hate them for trading, but for options, they're pretty decent. So if you take a look at this, this is the strike price. So if I sell this, right now the bid is 68 cents and a contract is 100 shares. So I would get $68. And that means that if price fell below $20 before the expiration date, which is April 8th, I would have to buy 100 shares of stock from this person, okay, if they exercise the option. I would still get to keep the 68 bucks, but, I'd be forced to buy these shares. So essentially, if AMC drops under $19.30 before April the 8th, I'm going to lose money. But here's the reality. What if I went down a couple levels? What if I went down to, say, $17, right? And I sold this put for $4 per contract. Now, I know what you might be thinking, $4, that's nothing. Well, it depends on budgets. It also depends on the put you're selling. It depends on a lot of different factors. I'm just using AMC as an example. But let's say that I sold this for $4, okay? In order for me to lose money, AMC would have to drop under $16.95 before April the 8th. Today is April the 6th. That's 8:30 Central Time. So essentially in the next 2 days, this stock would have to drop about 16.6% for me to lose money, right? So if you think about that, there's a very good likelihood. We can go look at a chart. Again, what was that? We're talking about $17. So it would have to fall all the way down to roughly here in the next 2 days for me to lose money. So if you think about that, and we can't predict the future, but we can say that statistically there's probably a pretty good chance that even if it starts to go lower, it's probably going to find at least some support through this area here. If I put a volume profile on there, we'll probably see some volume profiles ledge of support there. So yeah, see how there's a ledge of support right there? So it'd have to break all the way through that support level in order to make me lose money. And so the reality is I'm probably going to win this trade 90% of the time. I want you to think about that. Let's say that I took a similar trade 100 times. Let's say that when I was right, just for easy math, let's say that I was trading, let's say I was trading 10 contracts, right? So when I'm right, I make 40 bucks. So the only thing that has to happen for me to make 40 bucks is this has to stay above this level, okay? And let's say that I win 90% of the time. That's $40 per win times 90 wins. If my math is correct off the top of my head, that should be $3,600. And let's say that I lose 10 times, but when I lose $200, right? I lose 5 times as much when I'm wrong as I make when I'm right. And by the way, with options, you can set a stop loss on the option. You don't actually have to have unlimited risk where you're buying that stock. You can actually say if that option goes up in price to X dollars, I'll close the option for a loss and move on to my next trade. So let's say that on a loser, this person loses 200 bucks. Of course, they're going to lose $2,000 on those 10 losses. They still come out $1,600 ahead, right? After 100 trades. And essentially what they're doing is they're like an insurance company or they're like a casino. Think about a casino, right? A casino doesn't make its money by taking $10,000 from every person who walks through the door. They've got thousands and thousands and thousands of people coming in to play games, right? They're going to take maybe 50 bucks, 100 bucks, 500 bucks from the average person. Every once in a while, somebody's going to get lucky, maybe win 5, 10, 15, 20 grand off of them, but they're making, little bits of money from most people, and so they have that edge. That's how selling options works. You're basically taking trades where you have a very, very high probability of success. You make a little bit when you're right, and you lose a lot when you're wrong. But you're right so often that you're a profitable trader. And there are also people that trade this the exact opposite. There are people who will buy those puts and say, hey, I know I'm going to lose the majority of the time, but when I'm right, I'm going to make so much that it doesn't matter. Now, of course, what they would be doing is they would be using TA, technical analysis, or fundamental analysis, depending on their trade style, and they would be looking for things where they thought there was a legitimate reason that this was suddenly going to drop through that level of support. right? Maybe there's, maybe they were, buying puts, for example, way up here. Right when it got to that level, maybe they said, you know what, I'm gonna load up on puts because they thought they had a really high chance of success. Well, obviously they would have been right, and they would have made a lot of money on that drop, because if they're buying the put, for example, let's say that they bought this put right here at 34 bucks. Okay, and let's say that they paid at that time, I don't know, so they paid $200 for the contract, and they bought 10 contracts. So they spent $2,000 on the puts. Okay, but 10 contracts means that they have a right to sell 1,000 shares at $34. Well, if they held that, maybe they bought a put that was good for a month. By the time it got done dropping, maybe they closed it down here at $24. Well, they just made $10 per share times 1,000 shares. They just made $10,000 on their $2,000 risk. So it's the exact opposite, right? They're running a 5-to-1 reward to risk, whereas this other person's running, a 1-to-5 reward to risk. So there's different things you can do with options, and the nice thing about it is if you play them correctly and you're using stop losses and things like that, you have a very limited amount of risk, and a lot of people don't get that. A lot of people got very, very rich off of AMC in 2021. And it wasn't people that were doing what I was doing. I actually bought shares, like out of my pocket. I bought shares down around $4 over here. I sold them at 21. This went up to 25 in overnight trading, fell back down. I bought them back here and then sold them on the next pump. I made good money on it. But the people that got really, really wealthy off of AMC, back when it was like $2 and $3, they were buying calls, right? Instead of buying the shares for like $3 a piece, they were buying calls for like 30 cents or $30 per contract. And so they might have bought like 1,000 contracts for like $30,000, right? Now, if they were wrong, of course, they might have lost $30,000. But think about that. Say they were paying $30 a contract. They had 1,000 contracts times 100 shares. That gave them the right to sell 100,000 shares of AMC. Well, if AMC goes up to $70, right, which it did, and you're making $70 per share times 100,000 shares, oh yeah, $7 million if my math is right, right? So people got super rich by buying calls back here. Just really fascinating stuff, okay? And again, if you're wondering, well, why didn't you buy calls back there? Why were you long in stock? I didn't trade options. I didn't know hardly anything about options. I'd only traded like 5 or 6 options contracts ever by that point. I didn't really get into trading options until the summer of 2021. I started dabbling with them because I was shorting some tech stocks, and I didn't want to have naked shorts open where it could just go up against me and completely wipe me out. And so I was buying bearish puts. For example, on NEO, right? I was buying bearish puts back here. I had actually shorted it in February 2021. I shorted it this green week right here, and I got stopped out on that wick, and it really pissed me off. And so the next time it came up, I was like, I want to do something different. I don't want to get stopped out on some stop hunt again. So that time I actually bought puts instead, right? Because even if it went to $1 billion, the most I could lose is whatever I paid for the put. So yeah, options, really neat stuff. Again, don't consider myself an expert, consider myself fairly new at it, but I do view them as being a very exciting opportunity. And what I was talking about earlier in the Facebook group, I said something about time decays and edge. Well, what that means is, if you're selling options, they expire. And every day that goes by, that option becomes worth less and less, as long as it's what they call out of the money, meaning that it's not like if you're selling a put, as long as the price is above that strike rate, it's quote unquote out of the money. And so as long as it's out of the money and not close to the money, then as time goes by, it automatically loses value. And so if you're selling it, that's a good thing, because it means that you can, either hold it, and when it expires, you just keep the premium. Or let's say that you sold this put a couple days ago for, $10 a contract. If you wanted to, you could buy it back right now for $5 a contract and close it and keep the profit. So that's the nice thing about it is, the time is on your side, and it's not about picking the exact price. It's simply about saying, this won't happen. It's almost like a binary thing. This will happen or this won't happen. So anyway, hope you guys enjoyed that video. If you have any questions, be sure and let me know. Please remember, I am some guy sitting in a spare bedroom. That means that nothing in the video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. This is James with Crypto Common Sense, reminding you all to please trade safe.